Dear students, hope you are doing well. Today I am going to solve with you the question number 1, which has 10 multiple choice questions. The paper code is 0452/12 May June 2010. So this 0452/12 and 13, they are the same papers. So let's start from question number multiple choice question number 1. Business use financial records to prepare financial statements. Another name for the financial statements there is final accounts. Which record is used in the preparation of the balance sheet? So financial statements. You know that financial statements is divided into two parts. One is the income statement, and second is the financial position. And balance sheet is also called as financial position. So we have four options: a bank statement, a cash book, purchase journal, and sales journal. What is a purchase journal? Purchase journal means recording only the credit purchases, or you can say bought goods on credit. So it is used for credit purchases. And similarly, sales journal, it is used for recording only the credit sales. So credit purchases goes to the income statement, and credit sales also goes to the income statement. And if we say the other effect of the credit purchases, so these credit purchases, they are creating, I am just writing A/B, accounts payable, also called as creditors, and credit sales, they record accounts receivable. So here we know only just the one side or one aspect, which is accounts payable, which is in the balance sheet as a current liability, and accounts receivable, which is a current asset in the balance sheet. So now here we can see that in option A and B, option A is bank statement. So bank statement is giving us the details at the end of the year, that how much amount we have in the bank. So this is giving the information about the bank balance. We may have a debit balance, which means that the money is in the business bank account, or we may have a bank overdraft, which is a current liability. But cash book here is also in the option. And you know that in the cash book, we when we are preparing the three columns cash book, in which we have discount allowed, the cash, and the bank on the debit side, and similarly discount received and cash and bank on the credit side. So cash book is giving us more information from where we can make our balance sheet. Bank statement is also providing the information, but the bank statement is providing information only if the transactions are, the business is doing all the transactions by check. But generally businesses, they maintain a cash book. Why? Because in the businesses they have cash transactions and transactions by check. So cash book is more suitable for this. So in question number one, our answer is cash book. Now let's go to question two. Which document received by a business are used to write up the purchase returns journal? The bookkeeper or the accountant needs to write the purchase returns journal, and for that, business document received. So, which document he will receive in order to write this in the purchase returns journal? Let's check one by one all these documents. Again, four options are there: credit note, debit notes, statements, and sales invoices. Sales invoices. What is a sales invoice? We say that when the goods are sold on credit. When the business is selling goods on credit, the business issues an invoice to its credit customer. And that is recorded in the sales journal. So for the sales invoice, this will be recorded in the sales journal. There are seven books of prime entry: sales journal, sales returns journal, purchase returns journal. Then you can say cash book and petty cash book and journal. So sales invoice will go to the sales journal. Statements is not a journal. Statements is just a document which is providing all the information that how many transactions in a month or in a year are done by the business with its credit customer, like how much amount the business has to take from the credit customer, the opening balance, how many goods are sold, the credit sales, then the credit sales returns, amount received from credit customer, discount allowed, bad debts, and then the closing balance. Debit notes. Debit notes means that debit note is recorded in the uh, debit note is again not recorded in any journal, because generally when the goods are returned by the credit customer, they issue a debit note to the seller. The seller is then issuing a credit note as a confirmation that yes, for example, all the transactions are accepted. So in that case, the seller will issue a credit note to the customer. So our answer is A, a credit note. And when the credit customer, he will receive a credit note, then he will write in his or her purchase returns journal. Multiple choice C. A business keeps a petty cash book with an impress amount of 300, and during September the following transactions took take place. Impress restored on 1st September, so it is 100. Petty cash drawn from the bank on 15th September during the month is 150. Expenses paid from petty cash 400. What amount will be required to restore the impress? Restore the impress on 30th September. And here you can see that the impress amount, the limit, impress means the limit which the business has for each month to pay the petty cash expenses, it is 300. So it means that when on 1st September it restored 100, so the opening balance was, or you can say the balance brought down was 200. So I am just doing a simple calculation. 200 was available On 1st September, he restored 100. So now the impress amount is 300. Now during the month 15 September, 150 is drawn from the business bank account. So now the available balance is 450. 400 is paid. So it means the remaining balance left is $50. And now to restore the impress on 30th September means at the end of the month, what balance we need to restore? So we need to restore this with 50 because 50 is already available with the business. 250 more, and again we will have a balance of 300 for the next month. So our answer here is B. Let's go to the next multiple choice. Which error would not be revealed by a trial balance? Here you can see that this is in bold. Black would not be revealed. Revealed means will not be shown by a trial balance. Four options are there: completely omitting a transaction, incorrectly balancing an account, making only one entry for a transaction, and recording a transaction twice on the same side. We know that in a trial balance, errors which do not affect the agreement of the trial balance, and they are error of omission, number two, error of commission, number three, error of principal, number four, complete reversal, then original entry, compensation, and transposition. So these errors, they don't affect the agreement of the trial balance, which means that even if the bookkeeper has made these errors, still our trial balance will be equal. So you can see that the first one is completely omitting a transaction. So this is error of omission. So this is your answer. Because incorrectly balancing an account, if you incorrectly balance an account, definitely both sides will not be equal. You will make the trial balance. In the trial balance there will be a difference. Making only one entry for a transaction, so let's say you have recorded on the debit side but you forget to record on the credit side, so the credit side will not balance the trial balance. And recording a transaction twice on the same side, again a transaction you have recorded debit and credit on the same side, so it means that the credit is recorded on the debit side, so again the trial balance debit side is higher or greater and it will not balance. So the first one is the right answer, completely omitting a transaction, which means that error of omission. In E, which will be shown on a bank statement? Cash paid into the bank, not yet credited, check dishonored, checks drawn, not yet presented, and petty cash payment. Which will be shown on a bank statement? Bank statement is issued by the bank. So the petty cash payment, petty cash, this is out because this is a cash payment. No bank transactions are involved here. Cash paid into the bank, not yet credited. Not yet credited means still the check or this cash is not deposited into the bank, or sometimes even the cash is deposited but it takes time, a processing time, and the bank has not yet credited that amount, so it is not recorded in the bank statement. Checks drawn not yet presented. Again, checks drawn not yet presented may have two reasons. Number one, the business has issued a check, let's say to its supplier, but the supplier didn't go to the bank to take the amount. And in the second option, even the supplier went to the bank to take the amount, but the check takes time, the processing time, because in the checks, a check which is called as bearer check and other one is called as cross check. So normally businesses, to be on the safe side, they issue cross checks. And cross check means that when the business is issuing this check to that person or that other business, that person or business must have an account and the amount will be transferred to that account. That's why it takes time. 2 to 3 normal processing days are required to transfer the amount. So that is still not on the bank statement. So only the option left is check dishonored. Yes, whenever check is dishonored, it is shown on the bank statement, and this is our correct answer. What is meant by the realization concept? Here you need to know the definitions of the concepts. So just like for example, transactions must be expressed in monetary terms. So which accounting concept is this? So this is money measurement concept. So here our right answer is revenue is recognized as being earned when the ownership of goods passes to the customer. This is the definition of the realization concept as well. Let's go to the next multiple choice question. A business values its inventory stock of items X and Y, and the following information is available. Item X has 300 units, cost price is 3 per unit, and net realizable value is $4. Item Y, 600 units, cost price is 6, and net realizable value is $5. Inventory valuation. What is the base for inventory valuation? So the rule is lower of cost and I just write NRV, net realizable value. NRV. Basically, what is the net realizable value? Net realizable value means the estimated selling price minus the estimated selling expenses. This is called as net realizable value. So as I said, the rule is lower of cost and net realizable value. So here cost is less, so we will select here. So 300 times 3 is 900, and here NRV is less, which is $5. So 600 times 5, this is 3,000. So 900 plus 3,000, 3,900 is your answer. Next MCQ H. What is the effect of not including intangible assets on the balance sheet? In the non-current assets, we have two types, tangible and intangible. Tangible means which can be seen, which can be touched, land, building, machinery, furniture, vehicles. They are our tangible non-current assets. And what is intangible, which cannot be seen? For example, goodwill. So goodwill is an intangible asset. So options are overstate the value of the non-current assets, overstate the value of the working capital, understate the value of current assets, and understate the total value of the assets. So overstate the value of non-current assets. This is incorrect because if we are not taking the intangible asset is a non-current asset, and as I said here, it is a goodwill. So if we are not including the intangible asset, the value of the non-current assets cannot be overstated because it is not recorded at all. So this is incorrect. Overstate the value of working capital. It has nothing to do with the working capital because the formula for the working capital is current assets minus current liabilities. So it is not applied here. Same is the case for the C. So your answer is D. Understate the total value of assets. Definitely, when the value of goodwill is not included in the intangible assets, the non-current assets, they will be understated. Next, which will appear in the income statement, profit and loss account of a limited company. So we have four options: debenture interest paid, preference share dividend paid, retained profit brought forward, and transferred to general reserve. So which will appear in the income statement? Definitely debenture interest paid. So this is your right answer. This is included in the income statement. Preference share dividend, if this preference share dividend, because for the preference share dividend, they didn't say that there are different types of preference share dividends like redeemable, irredeemable. So that is not in the syllabus. So at the moment, I am not going to discuss in details for this. So your simple answer is debenture interest paid, retained profit brought forward, transfer to general reserve. Uh, Preference share then depends that which type of dividend is this. So they are in the statement of changes in equity. Statement of changes in equity. So debenture interest, this is the business expense. And debenture means that when the company has taken a loan from the general public, just like the company is taking loan from the bank, sometimes the company is taking loan from the general public, so they are paying interest to them. So this is the business expense, and that is in the income statement. And the last one is a trader doesn't keep proper accounting records. So a question from the incomplete records single entry system. Her capital at the end of the financial year is higher than at the start. So the closing capital is higher, and she has not introduced any further capital, and there is no further capital. So normally, when we, even in the balance sheet financial position for the sole trader, in the capital section, when we write, we say opening capital. With this opening capital, we add the further capital, your fresh capital, you can say, introduced during the year. So just plus, then plus the net profit minus the drawings equals to the closing capital. And here it says that the capital at the end of the year is higher. So it means that the closing capital is higher. So no fresh capital. So let's assume that the opening capital is 15,000. There is no fresh capital. So dash. There is no drawings. So I'm just putting here at the moment dash. And the closing capital is greater than the opening capital. And let's say I am saying that the closing capital is greater, taking a value of 20,000. So it means that the net profit, for example, it is 5,000. So net profit is greater than annual drawings. So this is your answer. It cannot be a net loss because the opening capital is less and closing capital is more. Annual drawings are greater than the net profit. Annual drawings, if annual drawings are greater than the net profit, again the closing capital will go down. Assets less liabilities have reduced during the year. So no. So correct answer is the net profit is greater than annual drawings. So hope you will find this video very helpful. Keep watching the videos and thank you so much for your time.